Hey, what's up, guys? Welcome to episode 2 of Turtle Investing. Today, I'm going to be going over my portfolio in more detail and the companies that I am choosing to invest in. Kind of my thought process on how I want to approach my investments and where I want this portfolio to go, and kind of just like the strategy I am using for my investing. So yeah, basically my strategy is going to be to invest $100 a week. I just started it. As you can see, it's not does not have a lot of capital, but yeah, my plan is just to keep doing that. $100 every week. I will be adjusting which companies I'm putting more cash into, depending on their current price. But basically, I just will be dollar cost averaging into the portfolio. So right now, I mean, it's only been a few weeks, but we're currently down $1.03, or 0.48%, which, I mean, it's fine. Earned 4 cents for dividends, which is cool, I guess. So yeah, currently my portfolio. I just adjusted it a little bit, so that's why this is not completely at the target yet. But I just put my technology currently weighted at 45%, which these are the big hitters. So we got Apple. I don't really need to go into too much detail on these companies. I'm pretty sure everybody knows what these companies are and what they do. So I'll just go over it quick. But yeah, I got Apple right now weighted the heaviest because they are currently in a little bit of a dip. After the news about China banning, some iPhones. So yeah, that's why I'm weighting it a little bit higher right now. That will definitely get adjusted in the future as their price will hopefully go up, which I believe it will. That's why I am putting more money into them right now. And then Google, I am currently weighted at 20% in here. They are currently in a little bit of a price surge, them and Amazon. So Amazon is my next one. Those two are currently, yeah, they're in a little bit of a price surge. I completely believe in these companies. All these companies are very long term. They've already established themselves, and I still believe they have room to grow. That's why I have this percentage of my portfolio weighted the highest. But yeah, Amazon and Google are a little bit trading above their averages right now, so I don't have them weighted super high. And then I have Microsoft. Then I have Microsoft, which is currently weighted at 18%. They're not trading as crazy as Google and Amazon right now, so that's why I have them. I just adjusted this, just put it up to 18%. So that's why they're currently only down 0.3% in my portfolio. But Google's the only one that's actually been up for me since I've started this portfolio, which has only been a few weeks. But yeah, so Apple, I'm going to continue to put weighted higher as they are down right now, 3.37%. Next, for the portfolio, I am so before I did have my financial weighted at 20%, but I just adjusted this. So I wanted to bring up technology a little bit. And then I wanted to have my growth a little bit higher. So I just changed this financial portion of my portfolio. Currently have about $60 in here. It's only down a little bit, but these are pretty big companies that are pretty standard. This is nothing too crazy. I didn't want to put all of it into the same kind of financial companies. The only two that are very similar are MasterCard and Visa. They're both in a lot of the same kind of structure for their company. But the other ones are different. So Morgan Stanley is more about investing. JP Morgan is a bank, as you probably know, and Intuit is more focused on taxes and different financial services. So they're all pretty different other than Visa and MasterCard. But I weighted these all pretty evenly right now. The only one that I just adjusted was Intuit because they are a little bit in a price surge. So this strategy is dollar cost averaging. So I'm just putting I'm just going to keep increasing my positions with these companies because I do believe in these companies. But I will probably keep adjusting the weight of each company depending on how they're trading. So that's why I just adjusted into it. They are trading a little bit above their averages, so I just slid them down a little bit. Morgan Stanley was in a little bit of a dip, so that's why I just adjusted this. They're actually my biggest winner so far in this section. They're up almost 4% for me, which is cool. All right, and then going into the next section of my portfolio is my growth section. So currently weighted at 20%, but I just adjusted it to 25. So my reasoning is Disney. That's my biggest weight right now in the portfolio. Disney, I believe, is undervalued. They've been getting, if you've been following them in the media at all, they've been taking hit after hit. So their price has been down in the market overall. For me, it's actually been up because I just started this portfolio when they were in their biggest dip. So currently I have them weighted very heavily. This will definitely adjust as I believe Disney's stock price will go up. I believe they're valued at definitely over $100. Disney is currently trading at $85 a share. I think I bought in around 83. I only have 0.4 shares, so I'm definitely gonna increase this. I'll continue probably buying them as their price goes up because I do believe they're still very undervalued, even though their PE ratio is pretty high. Disney's just been around for so long. They have a very wide moat and lots of I think growth potential. So I'm going to continue to buy them. And then yeah, so that's the growth section of my portfolio. Is more focused on growth, not as much focused on dividends. Even though the tech is also not super high on dividends, those companies I just believe have a lot of room to grow, and I really believe in those companies. So these ones are a little riskier. I mean, I don't think Disney is super risky, but yeah, I'll get into the rest of it. So yeah, then my next holding is Nike. Nike, most people know what Nike is. I'm weighting them not like super high, but this will again get adjusted as Disney's price changes. But yeah, Nike, I believe, is a little bit undervalued. They're in a little bit of a dip right now, and I really like Nike. I like their clothing, I like what they do, their marketing. Everybody knows what Nike is, so I don't know. I just think they're a little bit undervalued based on their financials. They're still recovering a little bit from COVID and that kind of stuff, so I think they have room to grow. So this might change. I might up how much I'm investing in Nike, but I'm pretty happy with where it's at right now. It's only down a little bit, which is fine. I don't have a lot of money in them right now. But yeah, so that's Nike. And then my next company. So these two are, I would say, my riskier investments. So almost every company in my portfolio, I can see myself investing within the next like 10 to 20 years. I don't really plan on selling them unless something crazy happens. These two are probably the only companies that I'm not necessarily saying, hey, I'm going to keep this for 10 to 20 years. I think they have room for growth. I don't know how long I'm going to hold these though, but I do believe they will grow. So that's why I have them in the portfolio. I do like what they stand for. So this company, Enphase Energy, I'm currently weighting them. These two a little bit lower because, again, I think they are my riskiest investments, I would say, in this portfolio. This portfolio is pretty standard. There's nothing like too crazy about it. These are my two, like I would say, dark horses. So Enphase, a lot of people know what Enphase is. So Enphase is currently trading for $120. They've been down. They've been getting hit pretty hard. Their PE ratio is 30, which is fine. It's not great, but if you look at their financials, it's decent. I do believe they have some room to grow, though. I mean, I bought in at 129, and they're already down to 120. So they've been getting hit pretty hard. They're a solar stock, down 55% on the year, which you can see. So they've been getting hit super hard. it's, yeah, that's why maybe this is a little bit of a risky play. But I've looked at their financials. I like what they're doing with solar. So I mean, it's, yeah, maybe this isn't a great play. I could regret this later down the line. But I wanted to have some risk in this portfolio. I'm young. So yeah, I'm putting, I guess you could say this is a little bit of a gamble, but I'm gonna do it. Next, or last in this section of my portfolio, the growth, is GSQ. GSQ has actually been my biggest winner so far in the entire portfolio. I honestly didn't know that much about them when I first started investing, which is not a good strategy for investing. Don't do that. But as I did more research, I actually really like them. So this one I could actually see myself holding longer. I do like them a little bit better than Enphase. GSQ is really cool. If you want to look into them, I would recommend doing your own D&T. But yeah, I currently have them weighted around 14%. It's up 7.5%, which is sweet. I mean, that's awesome. Obviously, I wish I had more money. They are currently trading at $37. I bought in at $34. Yeah, their PE ratio is super low. So if you look at their financials, I mean, they have good financials. They have a good dividend yield. Yeah, so GSQ is investing in healthcare products, cancer research, different sorts of drugs. You can see here. Well, this is not a good article, but yeah, GSQ. Yeah, do your own research. I looked more into them, and I like them as a company. Again, I would say GSQ is a dark horse for me. The price is not crazy or anything, but if some of these drugs end up working out down the line and releasing and helping cancer patients and stuff like that, it could be a big financial upside. So I'd say this is a riskier play for sure, but I wanted this portfolio to have some risk. To summarize, that is the growth section of my portfolio. I believe a lot of these companies have room for growth, especially Disney. I mean, everyone knows what Disney is, but I mean, they've been getting hit super hard. So I believe Disney's a long-term play. They have a lot of room to grow. So I will probably keep them in my portfolio. Definitely adjust this. Nike, again, pretty standard stuff. Probably keep these two. Enphase, risky. GSQ, a little risky. These are the risky plays. But I like them. I honestly, especially GSQ. Look into GSQ if you haven't. All right, and then going into the last section of my portfolio is the consumer and healthcare section. So currently the weight is 15%. This is actually the only part of my portfolio that is currently up, which is interesting because these are my, I would say, quote unquote defensive stocks. So they're pretty standard companies. You've definitely heard of these companies. But yeah, let's take a look here. So far, I've had a gain of 44 cents. Return's been up 1%. This is also my dividend. So these are my very standard companies that pay dividends. They have lots of products, very wide moats, pretty safe. They're pretty blue chip stocks. So yeah, these are kind of just like, I wanted to have some dividends. I wanted to have some dividend paying companies in my portfolio, as long as growth companies that have more growth potential, but maybe they don't pay a dividend. I kind of like a combination of both, because previously when I had invested, I had just focused on dividends, and the portfolio didn't grow too much. The dividend income is nice, but when you don't have a ton of capital, I don't really think it's like too important just to focus on dividends. Maybe down the line, when I've invested more money into the stock market, as I get older, then I would put more focus into dividends and kind of just like safer bets and not more focus on growth. But since I'm pretty young, I have a lot of room, a lot of time frame for investing. So I want to have a combination of both. That's why I'm doing growth and dividends. So my companies in here are Johnson & Johnson, which is make a bunch of consumer healthcare products. United Health Group, which is a healthcare company. They're probably one of the biggest healthcare companies in the United States. And Coca-Cola, which has been around for forever, pretty much. They're pretty standard. Their stock price doesn't fluctuate a ton, but they pay a good dividend. Their dividend continues to grow. Warren Buffett is one of the biggest Coca-Cola investors. Obviously, I'm not Warren Buffett, but I'm just saying he's one of the most famous investors, and he loves Coca-Cola. So I'm not saying do it because of Warren, but I like their increasing dividends. So, and they're currently in a little bit of a dip, so maybe they'll go up a little bit. But yeah, so far Johnson & Johnson, United Health Group, they have both been up for me, which is cool. But yeah, this part of my portfolio is not too crazy. It probably will not change a lot. It's pretty standard. I'm just going to keep dollar cost averaging. I like their dividends. So yeah, this is my current portfolio. I will continue to invest weekly. I could change how much I'm investing down the line, but for now I'm going to continue doing $100 a week. I've only been doing it for a few weeks. The portfolio has not changed a ton, but my goal is to hold this for a while. As I keep investing, I mean, I do believe in these companies. That's why I've chosen them. They are long-term picks. I don't see myself really selling too much in this portfolio. The only thing that I would probably change could be the growth, and I might add companies down the line. I've been researching some other companies, so things could definitely change, but I'm very happy with the companies I've chosen to invest so far. I will just keep continuing to dollar cost average and start that snowball to increase my dividends and hopefully increase my returns. If I could beat the S&P 500, that would be awesome. We'll see. But yeah, so follow along if you want to see the progress of this portfolio. It will be cool to see where this goes, but I will keep updating the portfolio and making weekly videos on how it's doing. So thanks for watching.